How many stocks should you have in your portfolio? Now, this is always a polarizing topic. You're going to get a lot of opinions. You're going to get a lot of arguments about this topic. And I want to start by setting the tone to tell you that there's not really a right or wrong answer, because at the end of the day, personal finance is about what's best for you and for your money. Now, with that said, you can learn from successful long-term investors and lessons that have been learned along the way. And most are going to tell you that there are a certain number of stocks that's going to increase your odds for success. Now, of course, depending on if you're long-term investing or if you're trading, it's going to be very different. If you're a swing trader, it's not the same thing as investing. So we're focused here on long-term investing, holding stocks for 5+ years. And if you're a long-term investor, there's really two primary phases to growing wealth. There's the accumulation and appreciation phase, trying to grow your wealth. And then there's going to be the capital preservation phase. Once you've made that money, you've grown the wealth, not to lose that money. So depending on where you are in that spectrum, your age, your risk tolerance, your suitability, your goals, it's going to be very different. Portfolio is going to align to you and your DNA. It's going to be very unique to your individual situation. Now, what we're going to do today, guys, we're going to look at some best practices that could help you increase your odds for success, perhaps lower your risk, your volatility, without necessarily losing the benefit of the upside. Now, there's even a lot of debate on what the definition of a portfolio is, but I think most would agree with Investopedia. What's a financial portfolio? A collection of financial investments like stocks, bonds, commodities, cash and cash equivalents, including ETFs. It can include stocks, bonds. You can even include art, jewelry, cryptocurrency, whatever you want. Now, this part is very important. Diversification is a key concept in portfolio management. So if you're truly trying to manage a portfolio, you have to realize that diversification is generally going to be very important. Now, some people will say, well, diversification will decrease my odds for home runs. I'm looking for hyper growth and I'm just going to invest in a handful of stocks. You can certainly do that. That's your prerogative, but it does increase the risk. And if you really look at the definition at its core, when you look at about portfolio, building portfolio, it's about diversification. And as I mentioned in the intro, it depends on your risk tolerance, your objectives, your time horizon. It's all critical factors in what you decide to do what's best with your money. I think that portfolio management is the most important part of long-term investing. It's something that's not taught. And I think a lot of people they'll get a Robinhood app, they buy a handful of stocks, they call it the portfolio, and that's it. But is that portfolio really best for what you're trying to accomplish? So the question again, how many stocks should you own in your portfolio? So the number of stocks that you own, again, it depends on your time horizon, your risk appetite, and what you're trying to accomplish. There's no perfect portfolio size, but the generally agreed upon number is 20 to 30 stocks. A diversified portfolio ensures that your money is safe, that capital preservation if one of your assets dips. So if you're wrong, the thing is we have overconfidence effect. We think that we're going to be right on every stock. But anybody that's invested for a while knows that sometimes you're wrong. Even the best investors in the world, like a Peter Lynch, will tell you you're not going to be right every time. Peter Lynch said if you're right 6 out of 10 times, that was favorable, and he was happy with that. So if you're only right 6 out of 10 times and you have 5 stocks, is that really going to be the best strategy for you? I posted a tweet yesterday and I said that 5 cloud SaaS stocks is not a portfolio. Now, of course, that's my opinion. If you want to call it a portfolio, that's fine. The point of that tweet was just trying to help educate some new investors that might not be the consensus by most seasoned investors who's been successful. I've been investing almost 25 years. I've seen what can happen. I know what can go wrong. And I learned the hard way myself back 20 years ago. This is a very powerful quote. Whether you own 5 stocks or 250 stocks, they should come from various industries and markets. And this is really what I was trying to get at. You could call 5 stocks a portfolio, but if it's in one single sector, in my opinion, that's not a portfolio, not by definition. You need to have some diversity in other industries. So if you said I have 5 stocks in 5 different industries, I don't love that portfolio, but you could still label it a portfolio, just not a very diversified portfolio. And of course, if you have conviction, you want to put all your assets in one stock, that's your prerogative, but understand the risk if you're wrong. And people will say, well, what about, business owners? They have most of their assets tied up. Elon Musk has most of his tied up in Tesla. It's a lot different when you control the narrative. You're in control of your own destiny, okay? When you're investing in companies, you can do all the homework you want. At the end of the day, you're never going to completely be able to weed out all the risks. You think of Enron. Enron was a stock that everybody wanted to own in the late 1990s. People would put half their portfolio in Enron and it seemed like a no-brainer. Well, guess what happened? It ended up going to zero. And hopefully if you buy one or two stocks, that doesn't happen to you. And maybe you get lucky. And maybe you're just smarter than everybody else because you have that overconfidence effect. But just understand the risk you're taking. Of course, if you have a $500 portfolio, that's not going to be the same risk as if you have a $5 million portfolio. So again, it comes back to where are you at? Are you trying to accumulate wealth? Are you trying to preserve it? Maybe you're somewhere in between. Here's another article. It talks about a well-diversified portfolio reduces the exposure to unsystematic risks, the risks associated with a particular company or industry. So again, if you have 5 stocks in one industry, you're not accomplishing that goal. And above that, while there is no consensus answer, there is common thought that diversification is absolutely key to long-term returns. I agree with that. Let's talk about another argument that we get a lot. Well, Warren Buffett has most of his assets in just a handful of stocks for Berkshire Hathaway. Here's something that people don't talk about, they don't think about. 80% of Warren Buffett's portfolio is invested in 7 stocks. That equates to $339 billion. Okay, that's great. So 7 stocks is 80% of the portfolio of $339 billion. But that's just the publicly traded portion of Berkshire Hathaway. It does not include the private assets. So you think of Geico and Dairy Queen and all those different companies under that conglomerate, it doesn't include that. So let's just look at the market cap. What's the market cap of Berkshire Hathaway? The market cap is $629 billion. Okay, so $629 billion. So 80% is invested in $339 billion, but the total number is actually $629 billion. And so that's much different when you look at it that way because the market cap is basically double the size of what the publicly traded portfolio is of $339.5 billion. If you follow the channel, you know that one of my favorite investors and influencers that influenced me to get to where I'm at is Peter Lynch. And Peter Lynch wasn't a hyper-growth investor. He was much more of a value investor. What a lot of people don't realize is that he absolutely crushed it when he managed the Magellan Fund. That was a mutual fund for Fidelity. He crushed the market for 10 years. He beat everybody. He demolished the S&P 500 and all of his competition. Everybody wanted to put their money in Peter Lynch's fund. And in the Magellan Fund, guys, at one point, he had as many as 1,400 stocks at a time. Now, I'm not saying that you should go buy 1,400 stocks. The point of showing you this is that it's possible to outperform the market with really as many stocks as you want. Some people will say, oh, this fired up wealth guy, you know, he likes to own all these different stocks. He might as well buy an ETF. Well, first of all, you have no idea what I own because the portfolio has changed a lot over the last year. But secondly, you can outperform with a ton of stocks. Right now, I own about 65 stocks, but I also have a very large account, right? And I have the time. This is my job, and I have the time to manage that. So the number for you might be 20 or 30. The point I'm making here, this is a professional, he had a team. But the point is, they were able to outperform the market for 10 years, dominate with up to 1,400 stocks. Again, I'm not telling you you should have 1,400 stocks. I'm just proving that you can outperform with a large number of stocks. One thing I like about Lynch is he'll tell you invest in what you know. He says, do not diversify simply to diversify. And I agree with that as well. I'm not saying that you should go buy a bunch of oil stocks when you don't know anything about the oil industry. That's not the point at all. You can be a hyper-growth investor and invest in different secular growth trends and not just put all your eggs in one basket and spread the wealth around a little bit. At the end of the day, you need to be able to own as many stocks that you can continue to research that you have time for. And so maybe that is a small number of stocks, but just consider that if you have 5 stocks, which is a small amount of stocks, and it's all in one industry, that just adds additional risk, and it doesn't necessarily mean you're going to outperform. It doesn't mean that at all. There's no guarantee that if you have a smaller number of holdings, they're going to outperform, and Peter Lynch is proof of that. Now, this is old school, but it's important history. Nobel Prize winner Markowitz, 1952, published by the Journal of Finance, first proposed the idea of modern portfolio theory, also known as MPT. So he theorized that investors could design a portfolio to maximize returns by accepting a quantifiable amount of risk, okay? In other words, investors can reduce risks by diversifying their assets and asset allocation of their investments using a quantitative method. With a well-balanced and calculated portfolio, if some of the assets fall to market conditions, like we've seen in 2022, others should rise on equal amount in compensation. Markowitz demonstrated that by taking a portfolio as its whole, so looking at the entire portfolio and not just one piece of the portfolio, it was less volatile than the sum of its parts. He assumes that most investors in their heart are risk averse, and this is true. In 2021, when the market was going up every day, oh yeah, I've got a high risk tolerance. Market falls and some of your stocks go down 50%. what did you start doing? You had second thoughts. Well, maybe I don't have as much risk tolerance as I thought I had. That means they are more personally comfortable with less risk and nervous and anxious with increased risk. This is just human nature. Also translates into the belief that it's not better to lose money than to find or gain it. This is a really interesting study. You can go check it out if you want. But essentially, this deals with human psychology. Given a choice between higher risk possibility with greater risk and a lower return possibility with less risk, most people will naturally prefer the portfolio with least risk, even if it means a lower return. Now, some of you say, no, I'm shooting for the moon and I want high return. I'm not telling you that you should go buy a bunch of value stocks and bonds and that makes the portfolio correct or anything like that. I'm just showing you some different perspectives, food for thought that maybe you can apply to your portfolio. And maybe you have one stock and you want to call it portfolio and you don't want to look at anything else. That's totally fine. I'm not here to convince you that you're wrong. So why does this matter? At the heart, MPT, mathematical justification for asset allocation within a portfolio as it amounts to a weighted average of the expected returns on individual assets. So I'm not going to go into too much more detail because it gets pretty deep and it goes into the weeds. So we're going to move on from here. But MPT is something, if you study, it really shows the correlation of risk. To me, it ties in human psychology and emotion. And it proves to me that diversification is important for long-term investors, especially ones that have any sort of anxiety about volatility in the portfolio. And I think everybody has that to an extent. So in a nutshell, guys, it's talking about not putting all your eggs in one basket, not into one stock or into one industry. Proper diversification of a portfolio can prevent systematic risks, but it can dampen, if not eliminate, unsystematic risk. So what this is saying at its core, guys, it's saying that you can have a diversified portfolio. You can still outperform and reduce the risk. In other words, by just having a handful of stocks, you're increasing your risk without guaranteed returns on that risk. What's one way you can achieve diversification without a lot of complexity? Because you say, well, I don't have time for 20, 30 stocks. Well, what you could do is you could add a percentage of your portfolio in an index fund like the S&P 500. So you could have something like 20% of your assets in your portfolio in S&P 500, then maybe the rest is in individual stocks. It really depends on you. Maybe you don't want the S&P 500. Think about the S&P 500, guys. If you look at the returns on it, people assume that it just gives you an annual return that's kind of static and the same every year. Since 1995, look at the returns, 37% positive, 22%. Look at this, negative 21% in 2002, okay, .com. 2008, negative 36.5%. Then you got a 25% gain, a 2% gain. There's a 1% gain, a negative 4%. We've had a monster run since the financial crisis in 2008. If you invested in 2008, you got massive returns, 25, 15. If you take the average though, the average return, the average stock market return is roughly 10% annually. But if you factor in inflation, it's really 6 to 7%. And this also includes reinvested dividends. Now, dividend stocks is a whole nother can of worms, but I always encourage to have some DGIF. Those are dividend growth investing for fired stocks, essentially where the stock is going to accumulate, it's going to grow wealth. It's also going to increase its dividend constantly each year, and you're going to get growth on both ends. Those are DGIF stocks. So those are growth stocks that really have a small dividend that are going to help you with compounding. But dividends are really important. In fact, in times of inflation, listen to this, guys. Dividends have contributed roughly 40% of total return on the S&P 500 since 1930. 40%. But during the 1940s, 1970s, and 1980s, when inflation averaged 5% or higher, like we're in right now, dividends produced 54% of that total return. 54%. And this is from Fidelity. So don't sleep on dividends. And that's why having that diversified portfolio, some growth, some spec, some DJF, it just makes sense. You say, well, I'm going to just bet on these 5 stocks because it's what I know the best. If that's your prerogative, go for it. But again, I'm trying to educate new investors that that's not the only way to be successful as an investor. There's a lot of ways to do it. And if you don't have the risk tolerance you think you do, maybe your risk tolerance isn't a 10 out of 10, it's a 7 out of 10. A great way to manage that risk is by diversification. Next, I'm going to show you some advantages and disadvantages of having more stocks in your portfolio. Then I'm actually going to I'm going to hand draw a sample portfolio of what you could consider a diversified portfolio to give you different buckets and just give you an idea. And this isn't something you have to follow. It's just an idea, some food for thought. Now, before I do that, I need to announce that this video is sponsored by The Motley Fool. If you want to see the 10 best stocks to buy now, visit fool.com/fired up wealth. And a reminder, guys, they don't tell me what to make or create. Motley Fool is a great partner, and I'm completely independent. So I create content that I think is important to you in the community. And that's exactly why I'm making a video about how many stocks you own in a portfolio, okay? But Motley Fool is a great partner. They do not tell us what to make. So what the Motley Fool is generally going to tell people, the average diversified portfolio holds between 20 and 30 stocks. Diversifying, there's that word again, your portfolio in the stock market is an investing best practice because it decreases non-systematic or company-specific risk by ensuring that no single company has too much influence over the value of your holdings. Same with industries. You don't want to have too much in one industry. So owning more stocks gives you more diversification, but then of course there's a certain point where you own too many stocks and it's not practical. You can't manage it. If your individual stock holdings are not well diversified, buying new stocks is probably your best option. So what are some benefits of diversification in a portfolio? Let's talk about large versus small portfolio size. So large, many stocks. So many stocks would be 30 plus. High diversification reduces risks, including company-specific and sector risks. Again, sector and company risks. You're relatively protected by large losses, potential opportunities if you're in a taxable brokerage for tax loss harvesting. And this is the main reason why I like to have several different stocks, because most of my money that I manage, so all my retirement's in ETFs. That's just how I do it. That's how I'm most comfortable, okay? I used to do individual stocks, but I've got to a point where I feel comfortable with what I've accumulated, and now I'm trying to preserve it the best I can. I've got an ETF, so you can do how you want. In my individual taxable brokerage, I like to have several different positions so that if I'm wrong on a stock, sometimes you're going to be wrong, you have the ability to tax loss harvest. So what are the advantages of smaller? So if you have one stock or 5 stocks, of course, if those stocks do well, you can grossly outperform the market. So the benefits of portfolio diversification, this really sums it up. Well-diversified portfolios, which are ideally diversified across companies, industries, and geographies, so have some international exposure as well, tend to consistently gain value over time. They're also less volatile. That's as simple as I can make it. All right, I promised you an example portfolio, and there's plenty of videos on the channel, so check out the channel. Subscribe if you have not. Click that bell to notifications. If this was helpful, drop a like and comment. But there are several videos on the channel. There's even a portfolio playlist where I started a new portfolio this year from scratch. So we call it the Fired Up Wealth Community Portfolio. And you can actually follow those moves. You can join patreon.com/Fired Up Wealth. The starting fee is like $10 and you get the exclusive videos. You also get the buys and sells in that portfolio. And we started that portfolio this year, and I showed you how to dollar cost average into what I call an 8 out of 10 growth that's diversified. It has DGI stocks, it has dividend stocks, it has hyper growth stocks, it has spec stocks, it has everything in there, okay? So what I'm going to do is I'm going to show you just a quick example of how you can build a portfolio. Now, this is going to depend on your age, your risk tolerance, your suitability, all those different things. So we're going to draw the first one. We're going to say ETFs. So ETFs, let's say, say you don't want a lot of ETFs, you're kind of young. Excuse my art. I know that it's not the best artistic ability in the world. But let's just say your first 20%, you're going to put it in S&P 500. We'll call it the VOO, VOO. So you might have 20%. Maybe you just put it in VOO. Maybe you mix it up. There's a couple other ETFs. You can put some growth ETFs. You could have, 2 ETFs, 10% each. You can do it however you want. Then you're going to have what we call DGIF. You can also do DGI if your risk tolerance is a little bit lower. And say you want to do, these are going to be stocks that are going to be like Tractor Supply Company, where you're going to get growth in the dividend, but also growth in the share price. And let's just say you want to do something simple like 20%. And again, guys, you can do this however you want. You can eliminate one of these tiers. You can make it 5%. You can make it 50%. You can do really whatever you want to do, okay? Then we're going to do growth, okay? So we've got 40% allocated, and I'm going to go, say, 45%. We'll do 45%. And this is just an example. I make portfolios all the time, and it just depends on the person, so you have to kind of tailor. This is going to be growth. Now, this is not spec. This is going to be growth. So you're going to think of higher quality, look for positive free cash flow, things like that. Speculative stocks are going to be more speculative, where they're burning cash. It's a story. It could be a huge stock, but it might not pan out. I call those spec, and I wouldn't put it in the growth bucket. You can do, again, whatever you guys want to do. So that's going to give you 85%. So what we're going to do is we're going to do 10% spec. And with spec, what you normally do is you kind of hedge on this. And what you do is you might do, let's say you have a $100,000 portfolio. So you have a $100,000 portfolio. You got $10,000 in spec. You're going to do 10 stocks, $1,000 in each stock, and that's going to hedge the risk. Because again, if you're right 6 out of 10. So the idea behind that is to say a couple of those stocks are 10-bagger stocks over the next 5 or 10 years. Those 10 baggers are going to outperform and going to carry any of the debt. Even if a couple of those companies went out of business, you're still, if you get a couple of those right, those home run balls right, that basket's still going to grossly outperform. And you can do your whole portfolio that way if your risk tolerance is astronomical. If you want to do that, I personally wouldn't do it, but you can do, again, however you want. And then the last one, so you add this up, right? That's 95%. So you're going to have 5%. You're going to say, what's left? 5%, I want you to have some cash at all times. Now, I know this is hard to maintain the cash. You're going to, when there's a dip, you end up buying. Do your best to have some dry powder. There's nothing worse than having no dry powder when your favorite stock's on sale. Let's say there's a big sell-off next week and you're at zero cash. It's really aggravating as all heck when you can't buy those stocks. So I always try to have some cash, and I'll admit I don't always have 5%. I do my best. In a bull market, though, you should be trimming and keep that 5%. In 2021, you should have 5%, sometimes even 10% cash. And that cash is there to take advantage of opportunities when your favorite stocks go on sale. But do your best. Sometimes I realize it's only going to be a couple percent. The idea here is that you're still investing, right? You're still working. So you're going to get money every paycheck, every 2 weeks. And so that cash is going to continuously replace itself every 2 weeks, every month, however you get paid. But you want to have some cash in there at all times. And then as you spend, you want more cash coming in. And that's going to give you 100%. This is going to give you diversification. Then, of course, within this, you have to pick the stocks that you think are best. Subscribe to the channel. There's tons of different videos out there that talk about different stocks we like, different ETFs we like, and so on. But this would give you a sample diversified portfolio with someone with maybe 7 out of 10 risk tolerance. If you have a 10 out of 10, it might look completely different. Again, this is completely up to you. You invest your money how you would like to. I'm not your financial advisor, and you got to do what's best for your situation. I appreciate your time and attention. Hope you have a great rest of your day. Take care.